Good afternoon. My name's Stephen Herwire. I'm the owner of Herwire Financial Plans with Direction. It is the afternoon of December 9th of 2022. And after the market roundup, I'm going to be talking about it may not be as bad as you think. First, some important disclosures. The opinions voiced in this material are for general information only, not intended to provide specific advice or recommendations for any individual. All performance reference is historical and no guarantee of future results. All indices are unmanaged and may not be invested in directly. All data herein is believed to be from reliable sources. However, no representation is made as to its completeness or accuracy. None of this should be construed as tax or legal advice, as I am neither an accountant nor am I an attorney. Consult your advisor prior to taking any action. Last night's numbers: Dow Jones Industrial Average closed at 33,781.48. Year to date, it is down 5.35%. The S&P 500 closed at 3,963.51. Year to date, it is down about 14.5%. The NASDAQ 100 closed at 11,082. Year to date, it is down 26.21%. Gold closed last night at 1808. Year to date, it is down about 0.82%. Bitcoin index closed at $17,149. Down 64.69%. The US dollar index closed at 104.88. Year to date, it is actually up almost 9.5%. 10-year Treasury closed at 3.508%. Year to date is up a little less than 2% from its year start at 1.51%. And finally, the S&P aggregate bond index closed at 198.68. Year to date, it is down 10.86%. The sky is falling. The sky is falling. Or is it? As the numbers indicate, this has not been a good year if you're invested in the stock market. Of course, it's not been good many other places either. Or anybody who's filled their gas tanks or bought groceries now know that in spite of FDIC insurance on one's bank account, purchasing power is also down. Just so everybody knows, purchasing power means stuff that you buy in the store costs more than it used to. The short-term answer to this problem is to budget carefully and shop for deals on things you need. Long-term answer is to not base investment decisions on current events, but stick to your plan. Remember, long-term investing success is plan-driven. Long-term investment failure is event-driven. Sometimes the best thing to do, as hard as it is to do nothing. This is better than doing the wrong thing. Now, thanks to the people at JP Morgan from their Guide to the Markets, I've got some charts that look really confusing, but I'm going to explain them. This is what's commonly called the measles chart because of all the little red dots on it. Now, this is a chart of the performance of the S&P 500, which is a broad representation of the overall stock market. It's the 500 largest companies in America and how it's done going back to 1980. Now, the red dots are the lowest point that the S&P 500 was at any point during the year. Now, for those of us who've been investing for a while, we remember Black Monday. It was in October of 1987. The market dropped 20% in a single day. And I remember this really well because I'd just gotten into investing about the year before, and I watched my portfolio drop by about 20% in a single day. A lot of us thought it was the end of the world. However, if you'd put your money in the S&P 500 on January 1 of that year and sat on your hands and done nothing, which is frequently the right thing to do, you would have actually come out ahead by about 2%. This chart, I pointed out the red dots already, but the gray bars are how the S&P 500 ended for the year. Now, all the ones above the 0% line, their points they're the ones where the S&P came out ahead. The ones below are, you guessed it, are the ones where the S&P 500 lost money for the year. Now, if you go through and do a careful count like I did when I first saw this chart, then you'll realize that it says despite, up here in the top above the chart, it says despite intra-year drops of 14% on average, annual returns were positive 32 out of 42 years. That's around 75%. So now if I had to guess, because we look over here year to date as of the date of this chart, which was a few days ago, maybe it was last week, S&P was down 14%. It's about what I had, but this presentation was generated a few days before I filled in last night's numbers. But during the year so far, we have been down as much as 25%, and we've gained some of that back. Now, my crystal ball is as good as everybody else's, but if I had to guess, my guess is we're probably going to be in one of those negative years. That's a guess. Could be totally wrong. The market could totally turn around between now and New Year's Day. I don't know. The thing is, most people don't know either. So why is this important to keep this in mind? Well, this chart goes actually back to 1950, and it shows the rolling averages, how the S&P, the bond market, and a 50-50, half in the S&P 500 and half in the bond market would have done. What they've done is, if you look at the green bar all the way to the left, that is the range of returns for the S&P 500 going back to 1950 over any given year. Now, the worst year was down 39%, and the best year was up 47%, and the stock market has performed all points in between. The bond market, if you pick the absolute worst year in the bond market since 1950, you were down 8%. If you pick the best one, 43, and again, all points in between since then. And if you decided to split the difference, put half in each, your worst case in any given year was down 15%. Your best case was up 33%. Now, here's the thing. The facts about the future are not known. No one can predict the future. So if you have a short-term need or for your emergency funds, and when I say short-term needs, it's like you're putting away money for a down payment on a car or a house, and you're going to buy in the next couple of years. You need to do something that's really liquid, preferably with FDIC or some sort of equivalent insurance. Right now, for things like that, it's not about, how much interest am I going to get on that? I'm not concerned about return on principal. I'm concerned about return of principal. If you put it in one of these vehicles, I've got a pretty good idea where they're going to be in a year and a half or so. The stock market, like I said, nobody knows. Okay, so shifting the focus, because we're talking about long-term stuff. I'm a retirement income certified professional, and that's a designation granted by the American College, and I focus a lot on people retiring. Now, average couple is going to be in retirement for 20 to 30 years. So let's see how the markets have done over 20 to 30 years using this chart. Now, this is where we look at the bars on the right-hand side, 20-year rolling periods. Now, if you had picked the exact worst 20-year period going back to 1950, you would have walked away to put your money in the stock market. You would have walked away with 6% on average over that 20 years. But if you pick the best one, it would have averaged 17% and all points in between. Now, if you put in what a lot of people think are safe bonds, you would have, if you pick the worst 20-year period, you would have averaged 1% a year. And we're going to talk about inflation in a few minutes. Well, 1% even before we got into this inflation problem wouldn't have kept up. Your best bond performance 12%. And if you split it down the middle, your range was 5% on average to 14%. Now, some of you are guessing why this is important, but for those who haven't, that's what this next chart is for. Now, this is a chart, the big gray bars that fill in everything are the average annualized return on a 6-month CD. Okay, in the 80s, your average 6-month CD over the entire decade was about 10%. Now, you see all these little colored bars in between. Okay, so I'm going to call your attention to the blue one, which is headline inflation. That's the one you see on the news. But there are other things that don't inflate at headline inflation, like housing, medical care, and college care, or college education costs. So in the 80s, your 10% CDs was more than enough to keep up with all of them. Matter of fact, it was almost double what headline inflation was. Now, when we get to the 90s, where your average rate of return on a 6-month CD, 5.4%. Now that kept ahead of all of the inflations except education inflation. We get into the 2000s, it gets trickier because now your average rate of return is about 3.3%. And it's keeping up with headline inflation and housing inflation, but it is not keeping up with medical inflation or education inflation. When we get into the 2010s, you're getting an average 0.5%, and it's not even close to any of the inflations. And so far in the 2020s, we got an average of about 0.4%, and it's not even a fifth of the lowest inflation, which in this case is education inflation. Headline inflation's about 5%. Now, some of you out there are going to say, well, Steve, I just heard on the news that inflation was 8-ish%. Where's that 5%? Well, in the first year or so of the 2020s, inflation was down in the ones. So that explains that. Here's the thing. If you are putting all of your long-term money, especially for retirement, in 6-month CDs or something of equivalent performance, then one of my mentors says, are you comfortable going broke slowly? Because if inflation keeps up, what costs $1 today is going to cost $2 in short order. At 8%, that's going to be roughly every 9 years. If it goes up, it's going to be even quicker than that. Key thing is, it's my belief that if you have a plan, which is going to include some equities, then you can navigate these particular, storms. But if you're just going to put it all in safe money, you're going to need a lot more. So, okay, once you graduate, be it from welding school or engineering school, you're going to need a different plan for each of these stages that are tailored to your individual situation. Okay, starting off in your working years, the most important and most urgent question to ask is, am I saving enough to retire in the manner and time of my choosing? The earlier you get the answer to that question, the easier it's going to be on your spending money, on your wallet. Okay, the next thing that you have to ask, and it's not as urgent as the first question, is, am I investing in the right place? Get the enough, especially if your employer offers a 401k or simple IRA. If they're offering matching funds, even if you pick the totally wrong funds, getting that free money is so important. Sign up right away, even if you don't know what to pick. I can help you figure out what to pick. Just contact me and we'll figure it out together. Okay, once you get in the glide path to retirement, the last about 10 years before you're planning on retiring, because all this time you've been building a ship. It's called the USS Retirement. Okay, so when you're getting in the glide path, you're making sure your ship is ship shape, and you're starting to load stores on food, medical supplies, and whatever else you're going to need for your retirement journey. You need a plan for that too. And then once you get in retirement, now my function as a financial planner is I don't just give you the plan and wave bon voyage as you set sail. I board the ship with you, and I am your navigator, because there's going to be hazards along the way. There's going to be metaphorical trade winds, and there's going to be cross currents. There's going to be a few storms. There might even be pirates, metaphorically speaking, of course. And then once you're done with retirement, we have to plan for your legacy. Now, we have to do that part before you're done with retirement. You want to make sure what you worked hard for all your life gets to where you wanted it after you pass away. And I can help with that too. If you have questions, would like to schedule an appointment, or want to see more videos like this, go to my website and click on the schedule an appointment. That's for appointments. It's a button in the upper right-hand corner on every single page of the website. I do Zoom, I do in person, I do on the phone. And there's a button, 2 buttons over from it. It's that red button in between the LinkedIn and Facebook buttons for YouTube videos. You can get to my YouTube channel and see more videos like this. If you or your friends want more information, you can follow me on Facebook, LinkedIn, or Twitter. Please like and subscribe to my YouTube channel. And for those who like the good old-fashioned telephone, my phone number is 518-631-2569. By the way, coming up early January, I will be making an announcement of the dates. I will be sharing LPL's outlook for 2023. I'm sure it's going to be a barn burner. Well, thank you very much. Have a terrific weekend.